Okay, it's Diane here. We're going to look at Chapter 4, which is Topic 3, which is business transactions. First of all, I'm just going to quickly go through the learning objectives for Topic 3. So we're going to explain what a business transaction is, distinguish between a business transaction, a personal transaction, and a business event. We're going to extend the work that you've covered in Topic 1 on the accounting equation, and we're going to have a look at the accounting equation and then introduce the concept of duality and double entry accounting. I'm going to illustrate the steps to analyse a business transaction and to show the impact on accounting equation, complete a transaction analysis worksheet, and prepare a simple income statement and balance sheet. And then we're going to look at and provide a brief overview of the components of an accounting system. So just as a note, read the text. In Chapter 4, what we require you to know is how to prepare an income statement and a balance sheet, but you will not be required to enter the items into the accounts of the firm. So what we mean by this is you can ignore or just read for interest any references in the chapter to the entries in the accounts, so where it talks about the rules of debit and credit, journal entries and ledger entries. These are not required for this course. You will be required, however, to analyse transactions using the method, so using a transaction analysis worksheet that we're covering in this topic. Okay, so we're going to start with business transactions. So what are business transactions? These are occurrences that affect assets, liabilities and equity items. They are recorded under accounting terms when they can be reliably measured in monetary terms, and this is to do with the monetary concept. So what we have is when we can reliably put a dollar value on the transaction or on what's happening to the business, then we can record a business transaction. The second criteria for recognition or recording is that they occur at arm's length. So they are a legitimate transaction. So an example would be if a business goes to Officeworks and buys stationery. Okay, they know how much they've spent because we can put reliably measure it because they will add up at the register, and it occurs at arm's length. The business is not associated with Officeworks. The second thing that we or concept that we look at is the entity concept. So every entity must keep records of its business transactions separate from any personal transactions of the owners. So it just means that the entity or the business is separate from the owner. So the owner might have personal assets being his home, his luxury boat, etc. And those assets don't appear in the books of the business. The business may also own the premises that they operate from, and that is an asset of the business. It doesn't belong to the owner of the business. So every entity must keep records of its business and transactions separate from any personal transactions of the owners. Okay, so it's important to note, however, that these two separate entities, the owner on one hand, so the owner of the business, and the business on the other, do interact. So for example, and there are transactions between the two, so where the owner either withdraws items, cash or other assets from the business for personal use. Okay, so this can be, he can take cash for personal use from the business, or if the business runs a garage, for example, and fills up the car, takes bread and milk from the stock in the garage shop, then that would be taking or withdrawing other assets for personal use, and they have to be accounted for. The other transaction that goes between the owner and the business is when the owner contributes additional funds, either in cash or assets from their personal funds to the business. So these two examples are business transactions, and they occur between the owner of the business and the business. For examples of business transactions that are quite common in most businesses, we've got the contribution of capital by the owners. So this would be the initial contribution and any subsequent contribution after the business is established, the payment of salaries to employees, the receipt of bank interest where they have money invested in the bank, purchase of a laptop on credit, payment of accounts payable, depreciating office equipment, the purchase of accounting software, payment of advertising. We've already spoken about owner taking cash from the cash register for personal use, and we also have cash purchases and cash sales. Okay, so to take this further, we want to distinguish between business transactions, which we've just covered, and personal transactions and business events. So personal transactions, these are transactions of owners, partners or shareholders of the business that are unrelated to the operation of the business. So an example of this would be the owner uses personal funds from their personal bank account to buy a laptop for personal use. The other type of event that we want to describe is what we call a business event. Now, business events are not transactions. They are something that occurs that will probably affect the entity in some way, but are not recorded as a business transaction until an exchange of good occurs between the entity and the outside party. So to expand on this, an example of this would be where the business contracts with an employee. So we might sign the contract or make the offer of employment with the employee or the prospective employee dated the 1st of February, but they don't start until the 1st of March. So it's not until they start the 1st of March and they start to earn their salary, and then when we pay their salary, that a transaction occurs. Because then it can be reliably measured. We know how much salary we owe them, and something has happened in order to cause that transaction. The signing of the contract itself on the 1st of February is simply an event. So it is something that's happened, but it can't be reliably measured, and there's been no exchange between the entity and the new staff member. So here, just to put this in a shorter explanation, the new employee signs a contract of employment today but starts work in 2 months' time. Okay, so we want a contract with that person to assure that we have their services in 2 months, but nothing happens until the new employee works and gets paid. Okay, so that's the end of part 1 of topic 3.